Most explanations of stocks versus shares hand you a tidy list of differences. Most of that list is invented. Here is the honest version. In everyday American usage, stocks and shares mean the same thing. People use them interchangeably and nobody will correct you at a dinner party. But there is a real rule underneath and it takes one sentence. Stock is the thing. Shares are the units of it. You own 10 shares of Apple stock. You do not own 10 stocks of Apple share. Stock is the substance. Shares are the countable pieces. That is the whole answer to the question you typed. So why am I still talking? Because there are 5 places where that distinction stops being a language quirk and starts costing people real money. One of them can hand you a stock with no vote attached and you will not notice until you try to use it. Let me show you all 5. Start with the one that catches people reading British filings. In the United States, stock is the default word. In the United Kingdom, shares is the default word. Same meaning, different habit. Australia and India follow the British pattern. That part is harmless. Here is the part that is not. In British usage, the word stocks has historically meant government bonds, not equity, bonds. So if you are reading an older British financial document or a UK fund breakdown and it separates stocks from shares, it may not be making the distinction you think. It may be separating government debt from company ownership. Those are completely different assets with completely different risk. That is a small thing that changes the meaning of a sentence entirely. And it only bites people who assume the words work the same on both sides of the Atlantic. Now the one that matters most. Sometimes one share is genuinely not the same as another share in the same company on the same day. Take Alphabet, the parent company of Google. It has 3 classes of stock. Class A trades under the ticker GOOGL, 1 share, 1 vote. Class C trades under the ticker GOOG, 1 share, 0 votes, none. And Class B is held by the founders and insiders, is not publicly traded at all, and carries 10 votes per share. Read that again. Same company, same earnings, same business. 3 completely different sets of rights. Economically, the 2 public classes are almost identical. Both give you the same claim on profits. GOOGL usually trades at less than a 1% premium for the votes, and that premium sometimes disappears entirely. Why would a company do this? So the founders keep control while still raising money from the public. It separates voting power from economic ownership. Issue as much Class C as you like, and the people at the top never get outvoted. Here is why it matters to you. If you buy the wrong ticker, you own the company's profits, but you own no say in it. For most people that is fine, but it is a decision, and a lot of people make it by accident. That is where shares stop being interchangeable units, and Alphabet is not even the extreme version. Berkshire Hathaway is. Berkshire also has a Class A and a Class B. Economically, one Class A share is worth about 1,500 Class B shares, but in voting power, one Class A share is worth 10,000 Class B shares. The economics and the votes are deliberately mismatched by a factor of nearly 7. Class A has never been split because Warren Buffett has refused to split it. Class B only exists because ordinary people could not afford a single Class A share. It was created in 1996 for that reason, and it split 50-1 in 2010. Same company, 1 share each, 2 completely different objects. There is a second version of this, and it applies to companies far smaller than Alphabet. Most shares you can buy are what Americans call common stock, and what the British call ordinary shares. Same thing. It is the standard version. You get a vote, you get a dividend if the company declares one, and if the company is ever wound up, you get whatever is left after everybody else has been paid. That last part is the one people skip over. Common shareholders are last in the queue, behind the tax authority, behind the lenders, behind the bondholders. Then there is preferred stock, which the British call preference shares. It behaves almost like a different instrument. Preferred shares usually pay a fixed dividend, and they get paid before common shareholders get anything. In a wind-up, they sit ahead of common shareholders in the queue too. The trade is that preferred shares usually carry no vote at all, so you have two things, both called shares in the same company. One gives you a say and a claim on the upside. The other gives you priority on the money and no say whatsoever. That is the second time in this video that the word share has meant two different sets of rights. The fourth place is counting, and this one shows up in almost every financial statement. A company does not have one share number, it has three. Authorized shares are the maximum the company is ever allowed to create. That ceiling is written into its founding documents, and raising it needs shareholder approval. Issued shares are all the shares the company has actually created and handed out over its life. Outstanding shares are the ones currently sitting in investors' hands. The gap between issued and outstanding is treasury stock. Those are shares the company bought back from the market. They still exist, they are still issued, but nobody outside owns them, so they do not count as outstanding. So outstanding equals issued minus treasury. Think of three circles inside each other. Authorized is the biggest, issued sits inside it, outstanding sits inside that. Now the practical bit. Outstanding is the number that matters. It is what earnings per share is calculated on, and it is what market capitalization is calculated on. Use the issued number by mistake, and you will overstate the share count, understate the earnings per share, and get a company's size wrong. That is not a vocabulary error. That is a maths error with real consequences. The fifth place is a stock split, and it is the cleanest illustration of the whole distinction. In a split, the number of shares changes, your ownership does not. If you held 1% of a company before a split, you hold 1% after it. More units, same slice. The pie is cut differently and nobody got more pie. There is one wrinkle worth knowing. Splits generally do not create fractional shares. If the maths leaves you with part of a share, the company pays you cash for the fraction priced off a stated date. You do not end up holding half of anything, and you do not have to do anything. Everything is held electronically now, so your broker updates the number in your account automatically. Nobody posts you a certificate. You will see the reverse of this fairly often too, where a company combines shares to push its price back up, usually to hold on to a stock exchange listing. Notice what changed in a split and what did not. The shares changed. The stock did not. That is the distinction doing actual work. There is one modern wrinkle that goes right at the word itself. Most brokers now let you buy a fraction of a share. Put in $20 on a stock trading at 200 and you hold a tenth of a share, which is odd because a share was supposed to be the unit, the smallest indivisible piece. Now it divides. What you hold in that case is usually a position your broker tracks for you rather than a share registered in your name. It still tracks the price, and dividends are normally paid to you scaled down to your fraction. Voting, though, generally is not something you can do with part of a share. So here is the honest summary. Stock is the thing you own. Shares are the units you own it in. In daily conversation, nobody separates them, and you do not need to either. But the moment you are choosing between two tickers for the same company, reading a share count on a filing, living through a split, or reading a British document, the difference is real and it is worth 3 minutes of your attention. The people who get burned are not the ones who use the wrong word. They are the ones who assume every share of a company is the same share. One thing I would like to know: did you ever buy a stock without checking whether it came with a vote? Tell me in the comments, because almost nobody checks the first time.